It's probably fair to say every trader has one of these, at least one. When I'm talking about a story of losing lots of money in a very short period of time. My next guest, Ignas Bakanauskas, took a small account. We're talking 3,000, 4,000 up to 46 in just 3 months, then blew it all in 3 days. He's never looked back since that time, unless it's to look at data, to check his feelings, check what he's looking at on the chart, and he's doing very well. He's now teaching trading, he has his own little group, they are doing well as well. And in fact, I was so impressed by his analysis, I'm thinking of joining one of his courses, because I also have blown my account during the crazy period we just had with Trump turning on tariffs, then turning them off again, and then back again. So yeah, I think he's very, very good with his analysis, very grounded, and I think you'll enjoy this episode. He's from Lithuania, speaks very good English, and away we go. Ignas, hi, welcome to the show. How are you doing?
Lovely to be here. Excited to speak, to be fair.
Okay, good. Yeah, I came across you on LinkedIn some time ago now. I was very impressed by not just your trading, but also your marketing of what you do as a trading coach. I thought we'd just start kind of at the beginning, really. Perhaps we're going back 5, 10 years to the point when you started to give trading a proper go, your ups and downs. Why trading?
Good question. Thank you. Um, can I get to the why after like 30 seconds
Of
of
course,
storytelling, you know?
take your own time.
I remember myself coming back from US, graduating high school there, coming back to Lithuania. I dove into work right away. I found a job first prior to actually getting into university. And I chased every single dream that you can imagine, having a job, having a good boss to learn from, grinding every single day. And I remember we at some point went to work on a project in Iceland. And Iceland was a very interesting space for us because I would have days sometimes where we would get so much snow that I couldn't even go to work, right? So I would be stuck a little bit. And university comes into play because in the university I was studying international business. So a lot of it had to do with company analysis, with stock prices, with looking into the marketplace and so on and so forth. So trading for me, I'm 31 right now. Trading for me came in at like when I was 2021. Because every single thing we did in university, I found it a little bit boring. And I wanted to always fool around with it, put in a $50 into something to see what will happen, What did we learn in school today? Let's implement it into the marketplace. I think that's where it all started. But answering the question that you started with, the why, I think I'm a little bit different considering the average person coming into trading because I really started digging into this in 2019 because I really wanted to figure out how marketplace delivers price. I always thought that not even thought, I've seen so many people struggle with trading because of my classmates, course mates, people in the industry overall, that I said to myself in a way that I made a choice, a decision not to get into it up until the point that I can't explain to myself how the market actually works. Is there anything that I can learn to study, dive into to really understand how price delivers? And so I started there. I did a lot of hypothesis testing, if we can
You're
say it
definitely a
like that.
maths type, aren't you?
Yes,
Yeah.
yes. I love my numbers, right? I'll just give you an example. In 2019, before I opened my first trade on a live account, I backtested 10 years of Euro USD 1 minute chart worth of data. Over 3,000 day trading days. I literally scrolled through it because I had no idea that you can code something up to make a backtest on MQL at that point. So I scrolled through it, right? I started my journey opening the first trade knowing Euro USD for about 10 years already, if we put it into perspective, you know? So when you went into the place saying maybe there's something that I was bad at or had an issue with while I was approaching it, I never ran into an issue of me being in the place where I would be doing something bad or something wrong because of my psychology, because I was chasing something, looking to trade more than I'm supposed to, make more than I'm supposed to, or anything like that. Every single issue came from me having a very big ego towards the marketplace. That I was never allowing myself to be wrong about anything, or just digging into it so badly that I would be struggling by the end of the day because of that, you know, and so on and so forth.
So it's kind of over conviction in your own
Hmm.
hypothesis.
Yeah.
Okay. Yeah.
Yeah.
You
Yeah.
don't want to intellectually be proven to be wrong.
Exactly that. Yeah.
Mm.
I would suffer badly if I would say to myself that, okay, I was wrong today. No chances. Can't happen. Yeah.
Yeah. Presumably you were so certain about things because you'd done this back testing and you thought, well, it's such a high probability this should go
Hmm.
my
It
way.
happens today, actually. Even if I love I'm live streaming a little bit right now, right? Day in, day out, when I work with my students, when I show my work to other people. Um, I love rewatching some parts of the live streams, right? There we have a tool which kind of makes cuts so we can post it on social medias and so on. I love it not because it helps us to make the posts and everything, but I love it because it takes the points where I'm the most active during the live stream, where I'm the most talkative and so on and so forth. I see myself even saying it out loud a lot of the times where I say that I know how the marketplace works, which is a thing that is not truth, right? It's not factual. But I backtested it so much that I got used to that term in a way of telling people I know how this works. Why? Because I have 16,000 lines of data on Euro USD already backtested, you know?
Okay, yeah. So once you'd done all that back testing,
Mhm.
you started with a strategy. How did you actually, well, first of all, come up with that strategy and then develop it?
I don't know if it's okay with you to name names, but
Sure.
I was in 2019. I was also in Michael Huddleston's private mentorship, ICT. He calls himself right now. He was a very small YouTube channel at that time, 40,000 subscribers or something. Now he's at 2 million, whatnot, right? Um, I went there, and I also came back by the end of the year in September back to Lithuania, and I got a position at the Forex brokerage. I used to work in aviation. I was very good with operations, with managing things, people, solving problems, and I got employed into a brokerage as well. And a lot of what I do right now comes from two things: the strategy itself as well, right? Is from work that Michael presented me with. He talks a lot about where the marketplace is looking to go, why the marketplace is looking to go there. He never told us how to open a position, what has the market to do, so we would push a button. He never taught us that, right? He's been always talking about algorithmic price action, price delivery, where the price is looking to go, what is the highest chance and likelihood of price doing something today, next hour, next minute, whatever. And a lot of that very much coincided with my work at the broker because I was in operations, right? A lot of the time, our job was literally to print the marketplace, whether it is nighttime when there's not enough liquidity in the marketplace, whether it is daytime and we have way too many orders in the book and we need to get rid of some of them, right? We would do the work that Michael was literally teaching us about the marketplace during the mentorship. So I never got into a space where I would um, have questions towards what he was teaching us. I very much believed in that, right? And right now, most of my book, let's say, open orders are trusting the theory that the price is manipulated. right? That the price is being algorithmically delivered into the marketplace and that it is manipulated, right? So I do a lot of waiting, a lot of just sitting like this. In a way, I'm reaching backwards right now. So when I trade personally, I'm always trying to be far away from the table. So when I need to open a position, I have to crawl back in so I can reach the mouth, fooling around
Okay,
with myself as well,
interesting.
right? Yeah, I do that a lot,
Is that a sort of way of controlling your impulses?
a lot. Uh, just having those obstacles that I have to go through so I can't do anything impulsive.
And what are you looking for? Because I mean, Michael Huddleston's way of trading is very much based on filling gaps, isn't it? And
Yeah.
moving toward liquidity.
Hmm.
So perhaps you, because not everyone will be familiar with that. So maybe you
Yes.
could just describe what that entails.
What he teaches about liquidity, imbalances, so on and so forth, it can have a many theories towards it, different vocabularies towards it, like imbalance, volume imbalance, fair value gap, like you name it, it's gonna have a name to it, in one or another way of saying it, right? What I use most in terms of what he teaches is he calls it power of three. People right now reinvented it into AMD, accumulation, manipulation, distribution. Why I do a lot of waiting is because I wait for accumulation to happen so I can identify that, okay, the marketplace is literally not moving right now, right? Usually it happens during Asian session, during nighttime, if we take a look at European time or very late at night in New York time, right? Asian session. Usually I'm looking for accumulation there. And if accumulation happens, I'm looking for manipulation stage to punch in, let's say, because manipulation is usually going to be something unexpected, something, even if you take a look at the price action, something weird, like you can even go, whoa, what happened here? Manipulation happened, right? Because it's going to run through somewhere that you never expect or somewhere where Michael says liquidity is resting, right? He says that a lot of retail liquidity is resting there. However, it is doesn't really matter, but there's orders that we can always agree because we can take a look at the book, right? The book is never lying in a way, right? So I'm gonna wait out the manipulation and then I'm gonna look to enter my positions in distribution phase, right? And I think the beauty of this approach towards, let's call it reading the marketplace. When I work with students, I always say that we're not teaching you how to trade it. We're teaching you how to read it. Because if you can read the marketplace properly, the push of the button just happens naturally, right? So what I do, I read the marketplace and I look for distribution phase, which is the most predictable, the most understandable stage of the marketplace, the most precise as well stage of the marketplace. Sometimes if you take a market that is very precise, for example, E-mini Nasdaq futures, you can be in situations when in distribution phase, you can find tops and bottoms of every single candlestick for like 3 or 4 minutes at a time, you know? So I'm very fascinated by power of three, the concept that he uses. All the rest, he talks a lot about mitigation, order blocks, fair value gaps, right? Imbalances in price. That's just something for me that comes more not from his work, but from work at the brokerage. Because in the brokerage, you usually print the marketplace using bid and ask price, right? So if one of the side of the market is better than another 3 times in a row, 3 seconds in a row, 3 milliseconds in a row, for example, the market is going to push to the upside, right? If it pushes to the upside, it has an imbalance down below because it has to return because the market has to stay liquid. Something pushing the marketplace to the upside, something has to push it lower to fill the orders, right? It's a zero-sum game, in other words.
Sorry, what time frames are you usually using for your analysis?
It would be a top-down approach, but real quick. I would real quick take a look at the daily chart, 1 hour chart, just to figure out what the marketplace has been doing
Yeah,
most
overall
recently.
direction. Yeah.
Yeah,
So you're mostly looking at perhaps the hourly and 30-minute to make your decision.
yeah. I execute on 1 minute chart, sometimes even 30-second chart. But higher time frame is very important for me because, in my belief, price is fractal. right? Meaning that if, for example, accumulation manipulation happens in every single hourly chart, because every single hourly chart has to have a open, a high, low, and close. During the first 10 minutes of the hour, usually the price is going to accumulate. Next, it's going to manipulate if the candlestick is going to be bullish to the downside. And then distribution next half an hour happens up until the point it reaches the highest point and it closes back into retracement, right? Every single candle has to do that. So if you take a look at, for example, higher time frame, you can find things in price action where it will say, oh, we are accumulating on the hourly chart because it's not moving anywhere, right? So when I go into 1 minute chart to execute exactly the same principle of accumulation, manipulation, distribution, I make choices right away. If we're on the hourly chart in accumulation, I know that for certain I'm not going to look to find the whole daily range during my execution on 1 minute chart. I'm going to take lower risk, lower size, maybe less trades during that day, right? But if I see that, oh, on 1 hour chart, we just took previous week low, right? And we accumulated on Monday and Tuesday for 2 days in a row. And Wednesday took previous week low. Oh, let's go then, right? Because then it's the stars start aligning. When I'm looking on 1 hour chart, starts aligning with lower time frame. And the more alignments you get in a way, I say then the higher the probability of a trade it becomes.
And what about risk management and so on? Are you, if you're quite confident of a position, an entry, are you very tight on stops or do you give it more space?
I give it space because I use stop losses not based on price action usually. I base them in terms of how much capital am I looking to risk, right? I think it's a book by Larry Williams that I read before. Larry Williams has a book and he talks about risk management in that book. If you want a reference, I can text you after I find it. He has a sentence in that book that basically he explains how he won the Robbins Cup in 1979 or something like that. He said that I never used a stop loss to allow myself to be right about the price, but I always use my stop loss to save my balance from burning.
Oh, that's
So
interesting.
I usually do the same approach in terms of opening a position, right? When I open the position, then it goes into, okay, so what is happening? I have this liquidity, I have these zones, maybe some mitigation, let's call it PD arrays in price that I'm looking at. If things start getting broken, I'm usually moving my stop loss, but not moving my stop loss to get stopped out, but I'm moving my stop loss to save my balance, to save the risk that I'm ready to take up on the position, right? Most of the stop outs on the position are going to happen not because of price action and what I see in price, but because of how much time I spent in the trade. I have in total 6 entry models that I use most of the time. Every single model, because of the back test, I know how much time it's supposed to take on average basis to pan out. So for example, if I'm going to trade a divergence into inverse fair value gap, right? Just a very simple model of Michael's. On 1 minute chart, I know that within 4 minutes, the price has to go towards the drawn liquidity that I'm looking to happen. If in 4 minutes it's not happening, I'm going break even. Usually I'm right while it's making that choice to go break even more times than not, just to give you an example, right? So a lot of my risk management trade, let's not call it risk management, because in risk management I have a few things that I can mention. In terms of trade management, I prefer using time instead of price action to stop myself out. In terms of risk management, I think that's the most enjoyable, the most fun thing that I do right now, together with my team behind this wall. Every single Sunday, they get an analysis from me saying, guys, listen, in my opinion, Monday we usually give 3 colors to every single day. Red day means no risk, yellow means half risk, or for example, yellow means we're going to use half risk towards the weekly bias that I'm expecting to happen, or no risk if it goes against weekly bias, right? Green day means full risk, right? What will happen is that I'm every single day when I'm live streaming, when I'm trading with a 2.5K account of that worth of balance, meaning that my risk for the day, if something silly happens, if something stupid happens, right, there's going to be that account right in front of me, because all the rest is being managed by my team behind me, which is predetermined every single Sunday, even before the market started moving, right? Because I know for a fact that human error is the most, how to say, most hurtful thing in trading. Sometimes I had situations last week, Thursday, I remember. I opened the two-fold contracts instead of 0.2, right? It happened during the live stream.
I've done that sort of thing before. It's
You know,
horrible. Yeah.
yeah. And then instead of risking, I don't know, $100 per trade, you risk $2,000 per that position just by a mistake, right? We have a risk management system that we built out, both automated and manual, that we execute day in, day out together with the team. So things like that doesn't influence my own personal balances, prop trading firms, our client balances are not being influenced, and so on and so on and so forth.
Okay.
Risk management is very, very human-esque right now. Yeah.
For sure. Yeah. I'm going to take a little break here and we'll be right back. If there's one thing that keeps me awake at night, it's knowing I've left a couple of dodgy trades open and I should have closed them at 9 p.m. GMT. So typically I don't sleep well. I wake up a bit frazzled. I can't wait to get that first black coffee. A couple more follow and quite possibly a crash later that day. So I thought, how about switch that out and try something different? And that's when I came across Magic Mind. Tiny thing, packed with 12 ingredients that are clinically proven to sharpen the mind, lower stress, improve memory, boost your immune system, and sustain your energy throughout the day. See, it is working because I remembered all that. I'm not on an auto cue. What's it taste like? Passion fruit is probably the closest I'd describe it as. And I really like it, nice taste. And here's the tasty bit. You can get 20% off your first batch through my link up here and in the show notes. You can pause, skip, cancel anytime. Why not give it a go? While the stock market crashes, at least you don't. Magic Mind. Okay, given you've got 6 ways of trading, mainly, let's have a look at your screen, your charts, and talk us through something that you've got.
Another problem. Let me open up. I
Sure.
always have trading view ready whenever I'm
I'm sure
talking
you
to
do.
somebody, teaching, showing around, right?
Yeah.
I will start very quickly by showing on chart how accumulation, manipulation, distribution happens and where do my focal points go to, right? If we would just take a look at the weekly profile, most of the time, for example, if we take a look at NASDAQ, NASDAQ is, I'm referencing it a lot because I love it right now. NASDAQ is in a very good place to day trade, at least in my opinion, right? Most likelihood, if we want to find a low of the week, it's going to happen on Tuesday on NASDAQ. High of the week is going to happen on Thursday, right? So what does it mean for Power 3? If we distribute the marketplace into 3 phases of accumulation, manipulation, distribution, right? Monday is usually going to find a range and it's going to get stuck within it, all right? It's going to have a very clear high above the marketplace that it fails to go through quite a few times, right? And it's going to have a very clean low that it's also failing to go through, all right? Accumulation, literally, market that is not moving. Tuesday, especially if we have red folder news, CPI, PPI, unemployment claims, stuff like that. We're going to see if we're looking for a drawn liquidity higher, a bullish candle on the weekly range, right? The marketplace is suddenly going to manipulate to the downside, right? What I'm going to do, I'm literally going to skip it. It's possible to trade it. Sometimes you're going to find key levels down here, for example, a fair value gap. on the hourly chart or something like that down below, right? That you can look for a bottom, but I'm literally going to skip it. And one of the first things that I'm going to be looking for is a concept that I use which is mitigation, right? When I consider trading I'm considering that people who are smarter than me, right? People who are running the marketplace, they always need to have a chance to get out of their mistakes, out of their positions, right? So if Peter entered the position here, he's in a profit, right? Maybe Tom pushed the marketplace to the upside, then Nicholas pushed it to the downside, right? Tom is going to be in a trouble now because Tom is in drawdown position, right? But Tom is usually going to have a possibility of mitigating his orders, meaning the marketplace is literally going to come back into this leg up, let's say, to allow Tom to get out of there. If Tom gets out of the position and the marketplace is allowed to go higher, what I'm going to see is a term, let's say, that we use, which is break of market structure. Because a mitigation block where Tom has to get out of his positions, right? Because the marketplace has to allow him to get out of them, get stopped out, for example, at break even or something like that, it's going to get broken. This is going to be the place where usually distribution phase is going to start on later down the line, Tuesday, right? Maybe Wednesday itself. And this is going to be a window where I'm going to be looking to open my positions, right? So mitigation is a very nice principle that we use. And a lot of mitigation is usually going to be surrounded by something that happens throughout the week as well, right? If we have an hourly fair value gap that holds in the price right here, one of the most beloved, let's say, entry models that I use has to do with divergences, and it has to do with inverse fair value gaps, right? So for example, if this is NASDAQ chart here on the left-hand side, right? Let me try to show you what could happen on a correlated pair to NASDAQ, which could be S&P 500, right? S&P 500, we're going to see do pretty much the exact same thing on Monday. But Tuesday, we're going to see that, for example, the same pair, which is correlated to NASDAQ, fails to take the low, right? We're going to see NASDAQ running lower into the fair value gap, taking liquidity, taking sell side down below. ES is going to fail to do that and is going to start distributing to the upside suddenly, right? What I'm going to note is I'm going to note this divergence between two marketplaces where one creates a lower low and the other one fails. For me, that's usually like a phone call saying, Ignas, take a look. Manipulation is over, distribution is starting, right? So that's what I do on higher time frame, if I can say that. On lower time frame, I think the easiest trade entry that we use has to do with fair value gaps. And I'll give you a very simple example. If the marketplace has been pushing lower, right, it opens up a fair value gap, the marketplace bounces away from it and just continues lower, right? If a bottom is going to form here because liquidity just got taken and divergence on higher time frame happens on hourly chart, just like I showed you, for example, once the marketplace is going to go above that fair value gap and is going to close above it, I'm going to use this as my potential entry towards higher prices, right? Where I'm going to enter, it's going to depend on the structure of price on very low time frames, 1 minute, 30 seconds sometimes, right? But if we're looking at a higher time frame, this is the condition that I'm going to be looking for, right? If I can show you, I can even show you an example of this happening on NASDAQ yesterday, if that would be interesting.
For sure.
Yeah, we can do that. So I'm gonna show you right here. I love trading market open. I love looking at the market open in terms of what happens 10, 15 minutes prior to that, right? And when I said that I love using imbalances, I have an indicator here which shows me new week and new day opening gaps, right? Every single market has a new day opening gap because there's an hour and 1 minute of no trading time, right? Same happens every single weekend. And we find a bottom here that has been formed at a new week opening gap, right? one of the trade entry models that I'm going to use that we actually took yesterday is going to have to do with the imbalances right here. When a bottom forms at a certain level, I'm going to use, just like I said, an inverse fair value gap, right? And you see on the run lower, very little, very, very small imbalance got created here, right? I'm going to extend it to the right.
Can you make it slightly larger so we can see it?
Yeah, easily. Yeah. You see, there's a gap between 9 a.m. and 9 a.m. and 2 minutes after. There's a gap in price right here, where the high of this candle fails to touch the low of this candle, right? This is going to be a fair value gap for me. And I'm literally going to wait for that fair value gap to get inverted, meaning closed above it. This was the entry point for us last night. Right here. We used stop loss right below the swing low, right? Because we then believe that the marketplace is not going to go below it because this fair value gap got inverted, meaning the structure got broken, right? Because you're expecting a fair value gap like this to hold and allow the price to run lower, right? And the drawn liquidity was for us the upside of accumulation line. Because what happens here from 7 a.m.? We have a very lovely level of accumulation right here, right? Where the marketplace is not really moving anywhere. We have manipulation to the downside right here to find a bottom at a weekly imbalance. And then the entry model sounds like this. If the marketplace is finding a bottom at the certain time period that I like, which is right prior to the market open, I look for an inverse fair value gap like that, so I can look for an entry to go right above the accumulation leg right here.
Interesting.
That's what I do day in, day out. Yeah.
Yeah. So it's kind of, to my mind at least, a kind of breakout strategy from a point of where you've got a strong liquidity,
Yeah,
right?
I agree.
And closing that fair value gap.
Yeah. Strong liquidity in terms of like having a magnet somewhere on the chart where you want the price to go to. I usually will pick that level and I'm just gonna sit here and wait like this for certain things in the marketplace to happen before I open a position.
Remind me what time frame that was. Is that minute?
1 minute.
Yeah.
This is 1 minute. Yes.
Yeah. Figured so. Cool. Interesting. So what other kinds of strategies? We haven't got too long to do all of them perhaps, but maybe another one example.
This strategy, why I showed you, because I always have, how's it? This is maybe me being nice, let's call it, but I very much love the fact that I'm representing something that my mentor taught me, right? That I'm still using his strategies, his approaches. One of the approaches that I have created myself, we called it Picasso fair value gap, right? And Picasso fair value gap comes from my approach towards the marketplace when I teach very beginner level approach towards the market. I use the painter's analogy, where in my belief, the marketplace is being painted, usually efficiently, right? Because you pick up some paint, you can brush the wall and it's very nice. It goes through, it's nice, it's lovely. But sometimes the painter is gonna run out of paint. Whoop, he's gonna go down there to pick up some of it, right? Leaving an imbalance in price in our terms, right? Which is gonna have to be filled maybe 2 times or 3 times because there wasn't enough paint before we went lower. That's the exact principle of accumulation, manipulation, distribution in price. And that's why Picasso fair value gap as a trade entry model got created by us. So where I'm gonna use it, it's gonna be used only on trading assets that have a futures index to it, because I'm going to use a difference between regular trading hours and electronic trading hours for it, right? So I'll give you an example to it. Again, NASDAQ, for example. NASDAQ is going to have a regular trading hours close on the previous day, 4:15 at night, New York time. And it's gonna have usually a gap up, because I don't know why the reason is, but Nasdaq usually runs to the upside every single night, 4 nights out of 5. That's it, right?
Which is the one that doesn't? Is that Friday?
Can't say. I would love to know that. Can't say. But usually we're gonna have a gap, right? Where marketplace closes and the marketplace opens up, right? Once I measure that, I'm gonna wait for the marketplace to open up. Usually, if we have a gap up, the marketplace is gonna open up to the upside, pushing the price to the upside, opening a fair value gap, right? I'm gonna note that even I have it here in the templates, first fair value gap of the day. That's gonna be the most important fair value gap of the day, because with Picasso's fair value gap strategy, if we have a regular trading hours gap up, like in this example, right? And we have a bullish first presented fair value gap, I'm gonna be waiting for the marketplace to go below it and give me an entry towards closure of regular trading hours gap, right? So what we're gonna do, we're gonna see that in the first 20 minutes of market open, the marketplace is gonna manipulate to the upside, leaving the first presented fair value gap. And as soon as the market is gonna close on 1 minute chart below it, I'm gonna look to enter a trade, stop loss above the most recent swing high, and I'm gonna look to attack the regular trading hours closure. You wanna see an example of this on real price action?
Yeah, for sure.
Okay, let me find something that we can use. Let's take a look. Regular trading hours gap, very little, very little, very little, big regular trading hours gap. But this will be hard to explain. Let me find a perfect trade. Here we go. This is price action from Friday, the 11th of July, right? We're gonna come to the marketplace and we're gonna do the first step, which is I'm in replay mode, right? I'm gonna look for the marketplace closure on Thursday at 4:15, right? And I'm gonna look for the marketplace opening, right? This is gonna be the gap that we're gonna be looking to attack, right? We can even measure it like this if it helps to see it a little bit better, right? That's where the marketplace opens up. We're gonna use 1 minute chart to look for the first presented fair value gap of the day, which we just got right here, right? I'm gonna annotate it. So let me move this down here. And what I'm going to be looking for, just like in the example that I gave you before, to the downside, this is going to be to the upside, right? So we're going to be looking to wait for the marketplace to close above it, right? Can we get that? Not yet. Boom. We have a closure above the first presented fair value gap right here. This is going to be my entry point. And we're going to let the marketplace run towards the closure of the regular trading hours gap. Can we have it pan out or not? I'm in a pickle now. I have no idea whether this trade is gonna pan out or not, to be fair. We should be good. Yeah. That's one of the trade entries that we developed ourselves, actually.
Yeah, so you're closing the gap, aren't you, on the previous night, as you said?
Correct.
Yeah. This is the Asian session, presumably.
The closure itself?
Yeah, I mean, the closure would be, as you said, around about 4, depending on your time zone. But
Yeah.
in the UK, I think it's it's 9, I think.
Yeah.
Yeah,
In
so
UK.
so yeah, in the UK it's 9.
Yeah.
But this one below, this is Asian.
The market open 9:30 New York time. This is 9:30 New York time.
Oh, okay,
Yeah.
right. So we're not. So it's 9:30 UK, US time, right? Okay.
If you're on TradingView right here in the right downstairs corner, you can go between electronic hours and regular trading hours. The regular trading hours shows you the only price action, which is during the market open hours, right? It's from 9:30 New York time till 4:15 New York time.
Yeah. Okay. You're talking about American time. Yeah. Fine.
Yeah.
Okay. Gotcha. Yeah. No, interesting. Yeah. I mean, I suppose it helps with something like Nasdaq on the huge bull run that we're in. That it increases the probability that it will come up and close that gap, right? Unless you've got some horrible news coming through.
I agree. We can go forever into details because I love measuring how big the gap is, how little it is. If the gap is at a certain size, I'm gonna look to attack the halfway point of the gap, and so on and so forth. Yeah. But this has a very nice painter's analogy to it. The marketplace was being painted on Thursday. Market closed. The painter got tired, picked up some paint down below, and had to close the whole gap. Right?
Yeah, no, it's nice.
Picasso for Valaga. Yeah.
Okay. Yeah, no, very good. I wondered how you were going to explain that, so now I know.
Yeah.
Good. So going back a little bit in time, when you first started, what were some of the mistakes you made, and how did you improve on those?
If I would open up my journal together with you, I think we would dive into two very big, like exponential learning curve places in my story. One of it is 2021 as a year overall. 2021, I made the choice that I'm gonna put down my own money into a live account and I'm gonna make 2% every single day because I made a calculation that if I deposit $4,000 into a trading account and I'm gonna make 2% every single day, I'm gonna be a millionaire by the end of the year. I run up on the account in 3 months to over 46,000 balance, and I burned it all in the next 3 days or so because I literally just got tired. And I was just so tired of pushing myself to a limit that I didn't even realize that the account was blown once it blown off. Have you seen any videos of like people driving rally cars where they crash and the subconscious, which is very automated, they crash, they roll over like 15 times, and the guy in the driver's seat usually goes, "Trut, trut." It's not going anymore, but he wants to start the car and he wants to keep on going, right? I felt exactly that after I blown that account because I looked to open a new position after the account was actually blown already. My mindset didn't even realize that there's no more balance in the account anymore. I remember that. And I think one of the main things that I have running around with me, let's say together with me, always the mindset of it's enough. Made $180, doesn't matter if it was a good trade or a bad trade today. I made $180. I don't care whether it's more or not, right? It's good enough.
So that's interesting. How do you know when to stop? What sort of signal do you read within yourself to enable you to stop?
It's not going to have to do with me, myself. It's going to be with the approach that I have towards the marketplace. If, for example, if my model that I trade with doesn't work 2 times in a row, I'm not taking a third trade because there's something happening. I'm always thinking about there's something happening somewhere that I don't see right now because of the emotion, because of my well-being, because of maybe what kind of day I had prior to opening the charts, right? I'm always thinking of a statistical chance of me making a mistake somewhere. And as soon as something doesn't work out the way it's supposed to work out, I'll say, okay, I'm done here. Doesn't matter the result, right? Because that year, not year, 3.5 months of me pushing to the limit was literally results driven. And I hate having my trading around a certain goal, around a certain result I want
Yeah, it's
to.
fatal, isn't it? Because you're making decisions based on what you want rather than what is there
Exactly,
available in the market.
exactly,
Yeah.
exactly.
What mistakes did you make that fatal week when you lost all that money in 3 days? What kinds, if you can remember, what kinds of mistakes were you making?
Going up the size way too quickly, I would say definitely. If I'll give you an example of what I'm doing right now with my trading accounts because of that. Usually, if we would take a look at prop firms, usually 50K account is the most money efficient, right? Usually 250 account and five 50K accounts are going to be more efficient for you than one 250 account, right? But for example, if I'm going to acquire a 250 account, what I'm going to do is for example, I'm going to copy my trades one-to-one to the 50K account, but I'm never going to copy my trades 1-to-5 to 250. I'm going to do 1-to-4. Just so if the 50 account blows up, that I don't care too much, the 250 account is still going to have space in it to be traded with, right? I'm always playing around with myself, just lowering the size, lowering the risk, making sure that if there's anything happening that is happening not according to the plan, I made choices before the plan going downhill to save myself. Yeah. I would say that's most of the things that I learned from that. Not upping the size too quickly. That's very, very big one. And the third one is that I never pyramid into trade. A lot of people I meet, they say, there's a saying where people say, cut your losses, but add to your winners, something like that. I don't know the real saying. I never add to my winners. I just close my winners and I look for a next position. Yeah, yeah. I just feel better doing it. It has a lot to do with feeling, how I like it, how I stand by it emotionally, instead of just looking to make as much money as possible.
Yeah, because there is a danger with that. I mean, I think it very much depends on what time frame, because you might say it's safer to do that in stocks, for example, over a period of time. But if it's day trading, hourly candles and what have you, I think you've got a risk that you're kind of entering the point at which your risk to reward is really now quite short or low. It's going to be more difficult with that second or third trade to be sure that you can make money. And of course, it could always collapse on you if you're going long, for example. Yeah, I know. I feel the same, really. I mean, I've made those classic mistakes of chasing, a good breakout, and you get in a bit too high, and the breakout turns out to be actually quite weak. It goes up like a rocket, but then just comes down like a ton of bricks. And then you're stopped out and so on. Yeah, it is risk.
Coming back to the journal, the second biggest learning curve point, I don't even know how to explain that. It has to do with me chasing the fact that I wanted to be right always. I got burned because of that story, let's say, so badly that even right now, when I live stream, when I teach, I always say to my students that we're not doing this to be right. We're doing this to take something away from the marketplace and come back here the next day. Meaning that we have to save our mental capital, we need to save our balance, we need to do everything that is within reason to be done so we can show up every single day, right? Because us just chasing the factor of being right and having a winning day every single day, winning session every session we approach the market, winning every position, that's wrong. It's just not possible statistically in a way,
Of course,
right?
yeah. And what did you do to sort of recover on many fronts, I guess, after a big loss like that? I mean, first of all, psychologically, and did you give it a long period of just being quiet, maybe going back to demo, or did you go straight back in, or what?
I remember perfectly, vividly. I downloaded data that I collected. It was over 3,000 positions in 3.5 months. I analyzed it. I got rid of every single losing position that I could understand that why I lost, let's say. All the rest are still with me because my win ratio is about 70%, right? So I'm still bringing in about 30% of positions that I can't really explain why I'm losing them. Because if I could explain why I'm losing them, I would literally get rid of them. But the turning point in my story is exactly that big loss, because I had collected so much data in terms of ideas I was bringing into the marketplace, hypotheses I was bringing into the marketplace, working, that I just literally, it took me like 3 days or so to analyze everything and say, okay, this is the trading strategy that I'm going to use for the rest of my life, because this is what brought me into that almost 1,000% gains in like 3.5 months, right? And then of course shattering everything. But that's the trading models that I use right now. That's the approach I use right now, is literally those trading positions filtered into a place that actually works for me right now.
Do you still remember those kinds of trades that caused you to have those big losses? I mean,
Ah,
clearly the entry point was not so good, but also presumably you moved the stop loss, or maybe your size was just way too big, or all of those. I don't know.
if we would open up the data set, actually most of the positions are going to be very similar. Pretty much every single position that was occurring out there was according to one or another entry model that I was looking to use. But then we run into an issue of me trying to be wrong. For example, opening up the stop loss a little bit more, or not wait instead of making a choice after 8 minutes that I should, but waiting 12 minutes for allowing the marketplace to pan out a little bit, right? Looking for a place where I would be scaling into the account as soon as possible in terms of growth and not allowing any losers to appear. Yeah, yeah, yeah. Up until the point I burned the account, the win ratio was like 96%.
Yeah, that I've had exactly that. Really good run, 90 something percent, and then completely screwed it all up. You know.
And that's the brilliant part of what Michael has been teaching. What I'm teaching right now is the accumulation, manipulation, distribution. What I found is that the market literally works in sequences like this. That's how price gets delivered. And it also gets delivered not only with that concept in mind, but it gets delivered with a concept of time being placed in there. Usually, accumulation stage is not going to be longer than 28 days. I'm just saying it out loud. You can take a look if you want to add that yourself, right? Manipulation state is usually going to be about 1 to 1.2 weeks long, usually being the keyword, right? Distribution phase is going to run about for 3 months total, right? I'll give you a very definite answer to why I burnt that account is because I didn't believe that this stage in the marketplace switched. I was literally executing on a market phase, which was accumulation at that time, because I started early. Most of the marketplace early into the year accumulate, right? I started very early into the year, fooling around with the accumulation phase, which worked. And then the marketplace started manipulating, running suddenly against all the ideas that I locked myself in because it was so good, so successful, right? And I never realized up until the point that that account was burned that I got just literally caught into a market phase that I didn't believe at that time that is being booked into the price. Yeah. That's why I do so much waiting right now. That's why I do so much waiting in terms of literally sitting here and giving a reason why not to open a position every single minute to myself out loud instead of why should I open a trade. I always talk about why not to trade, why not to acquire risk, why not to open a position. Never go into reasons, okay, this should be a good position. Like there's no such thing for me. It's always that. Yeah.
Interesting. So that heavy loss has sort of taught you a big
Yeah.
lesson, and kind of left you a bit scarred, but the scar is helping you win.
It's the best thing that has happened to me, I would say. Yeah. Yeah. Because it proved the concept at first, and it proved the concept that it works. I had collected the data, and the only thing that I had to do is just figure out where I was wrong. That figuring out happened suddenly and quickly. I think that's where maybe I'm lucky a little bit, because some people go through 2 years of figuring out.
Yeah, people like me.
No.
Yeah, yeah. I must join one of your. Talking of which, tell me a little bit about your course and the
Oh,
different
sure.
programs you run. Yeah.
My teachings at first, whoever you are, experience, not experience, is about price delivery first. We have a course which is 4 weeks long where we dive into power of three: accumulation, manipulation, distribution. We dive into it on higher time frame, lower time frame. Then we talk a lot about algorithmic price delivery theories, manipulations in the marketplace, liquidity pools, what to do when you see a double top in front of you, right? We talk a lot about the example that I gave earlier of Nicholas, Tom, and Peter having to mitigate the risk, right? We do that. I present you with all of my trading models, Michael trading models as well. And the goal of that program, the course, let's say, because it's filmed already, is to put you in a place where you can create your own trading model. That's my goal. I don't want you to go ahead and pick up Picasso for value gap and start trading it, because Picasso for value gap is something that works for me. My hair is dark, your hair is gray. We're different already, just to give you an example, right? So my strategy is not supposed to work for you because we're totally two different people, right? So we put you in a place where the goal is of that program to teach you how the price delivers. So you can be in the same room with your friend and say, okay, in my opinion, Nasdaq is going to push to the upside because of ABC happening in the marketplace. And the second goal of that mentorship is to put you in a place where you can create your own approach using the information, the tools I gave you, right? And then it all depends. Whether you want to work individually with me, we go there. Whether you want to backtest it yourself, we go there. I have a team that can help you as well. That's a different approach once more. But just to shortly put it in place, we, in my belief at least, we teach you how to acquire a skill set that can last you a lifetime. And then you make your own choice whether you're going to use it and where you're going to use it. I'll give you a very nice example of my fiance, right? She went through the course. She hates every single bit of information on it. She hates the fact that I'm doing it even because she sees how sometimes stressful it is, how difficult it is, how annoying I am when I come back home after a losing day, and so on and so forth. But what she does, she invests into SPY for almost 3 years now, and she's beating the market 3 years in a row as well, because she only invests when the marketplace is in the manipulation stage. Because SPY is supposed, like statistically, it's gonna go upwards only. She knows how to notice accumulation. She opens her positions during the manipulation stage, which is scary because the market is crashing. And she beats the marketplace about 3.5–4% every single year just doing that, because she finds better entries than just dollar cost averaging into her positions.
And it's probably safer, no? This
Sure,
it's almost like position trading, isn't it? Really? Yeah.
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 But that's the thing she does. Yeah, that's how she invests. Let's say.
Very good. Ignas, we should stop there. Thanks so much for joining me.
I very much appreciate the time. It was great talking to you.
Likewise.